Welcome everyone to episode 172 of the Trust the Plan podcast. I'm Nick.
And I'm Jim.
And it's all about the plan.
Trust the plan.
Yeah. So here we are. Today's March 23rd. Happy birthday to Mark Hopwood.
Oh yeah, I'm sure he's listening.
Yeah, we'll see. We'll see. Maybe this will be released in a couple weeks. But so today's the 23rd, and I'm really excited today because I've been working so hard on health since January 1st.
Mm-hmm.
I came back from vacation over the holidays, weighed, more than I have in years,
Mm-hmm.
and I was just so motivated for change, right? And so we went on the detox.
The detox,
right?
yeah. I had good results on that.
Yeah, we did it together. We had a whole cohort.
Yeah.
Everyone was feeling great, losing weight. And when that 21 days is up, I thought, I got 21 more days until my blood work needs to be done,
Mm-hmm.
and then what's the harm of going, and doing it again? And so I did the 42 days
Man.
and stuck with it the whole time, did really well. Then had the blood work, my wife left town, fell off the wagon, right? So I had like a week or two where I was pretty bad.
Mm-hmm. Mm-hmm.
But then since then, great again. And I had to go for a second blood work, long story. But just got those results and they're excellent,
Good.
right? So you really see the results.
See it, yeah. See
Right.
it live, yeah.
Yeah, you see it on the belt, on the waistline, on the the blood work, and I'm just so happy right now.
Yeah, that's encouraging, right? Because you can feel good and you can, like you said, tighten the belt a little bit, but you don't know the behind the scenes, right? Which is the lab work. So
Yeah.
it's nice to get that confirmed with some positive results there too.
Exactly. And we got the new T-shirts in, right? So the
I like it.
the whole Retire with Confidence secondary logo here.
Yeah.
So we're up to 119 subscribers. So like in no time we'll be the number 1 financial podcast in in Southeast Michigan, maybe.
All big podcasts hit that moment where they go viral, and 119 is going to double, and next
right.
thing you know, we'll be huge.
Yeah, exactly. We'll be on CNBC soon.
I think
right?
it's coming.
Okay, so if you want to get your T-shirt, what do you have to do?
Subscribe and let us know.
Yeah, you gotta let us know.
Let us know because we can't tell.
That's right. We don't know who our subscribers are. So if you're in Canada, or
Yeah.
wherever, here's the thing about Canada. Okay, if you live in Canada, we're not going to be able to send you the T-shirt. So whatever. Long story short, inside joke.
All our
right?
Canadian listeners just got a real
We
disappointed.
love the Canadians, but
Sure.
there's some things in place regulation-wise.
Yeah.
Anyway. So anyway, what are we talking about today?
I thought it'd be worth talking about taxes, right? We're in the middle of tax season. Everybody's thinking about refunds. Am I going to get a refund? What could I have done different? So I thought maybe it'd be worth just chatting about some of those things, just kind of a reminder.
Yeah, I think there's 2 good times for talking about taxes, and one is right now when we're thinking about filing, and then one is in the fall. I always think of it as Thanksgiving time when we should go see the CPA, have a tax planning meeting, understand how the year is looking, and you still have some time if you want to make some adjustments.
Yeah, absolutely.
So by now you have less options, right? But you can still do. You can
Yes.
still take action.
Yeah, you do. So this kind of refresher can be good for even if it's too late, right? Or if it's not too late for certain things, right? So if it's too late for some things, this is put it in the memory bank for the fall, right? This is the kind of things you need to be thinking of for next year or as this year goes on. But it's not too late to do other things, right? We have until tax filing day to make IRA contributions, Roth IRA contributions. These are all for prior years, so they can still affect your tax return. Even for last year. In addition to that, not everybody, but most people kind of know the Roth and the IRA, but you can still make HSA contributions for prior year. If you're self-employed, you can do SEP contributions or single 401k contributions. These are all things that
Sounds like alphabet soup, where do you start?
I know, right? Well, where you start, actually, I didn't say this to begin with, but where you start is you work with a CPA, right? I think one of the most important things is that you're doing that ahead of time and you're making sure that they're helping you along this process. Because these simple things that if they go overlooked by an individual, more than pay for the cost of the CPA, right?
For sure.
But yeah, making prior year retirement plan contributions is a great way to still affect your situation even though we're into the new tax year at this point.
So how do you approach IRA, non-deductible, IRA deductible, or Roth? What's your mindset?
Yeah, I mean, we really love Roth. Roth is tax-free forever. There's tons of benefits for Roth. If you find yourself in a difficult tax situation, though, maybe a pre-tax contribution into a traditional IRA is the route to go, this year, and then you can adjust the situation so that next year you find yourself in a better situation where it makes it more advantageous to do the Roth again.
Yeah, there could be years where you want to do an IRA and years where you want to do a Roth, right? What are you going to do this year?
I'm going to do Roth.
Yeah, me too.
But something that goes overlooked so often by people is HSAs, right? HSA is triple tax free, so you can get all the benefits of the pre-tax contribution and the benefits of the Roth, as long as it's used for healthcare. So that's been my way of taking advantage of pre-tax contribution while doing Roth contributions.
Yeah, you can do both, right?
Yeah.
Excellent. While we're talking about Roth and 401s and HSAs and everything, I challenge you to look at your company's 401 and see if they allow after-tax contributions, because more and more companies are allowing this, and most people are not taking advantage because they don't know. And if you do have that as part of your plan, it can be like a mega backdoor Roth kind of a deal.
Yeah.
Right?
Yeah, the way it stands now is those after-tax contributions into a retirement plan can be rolled into a Roth at separation of service. So what a huge benefit, right?
Huge. What do you say to people who are like, look, Jim, I know that we can do the IRA right now for last year and save a little bit on taxes or do a Roth, but is it really going to matter in the grand scheme of things? We're talking about like $6,000. Is it really going to move the needle? What would you say?
I think in a snapshot, yeah, it's not that big of a deal, right? It's a small amount, but the point is consistently doing these things over time. Like so many things with investing, it's having a consistent pattern of doing it over long periods of time that will benefit. So, I think that these small things added up over the many years come out to be a significant difference for sure.
I agree. What if you're finding yourself taking required minimum distributions now and you're age 73 and you're charitably inclined, you don't need the money, right? You're going to take the withdrawal and it sits in the bank. I realize not everyone is fortunate enough to be in that position, but we do have people that we see that do that. What kind of options do they have?
Yeah, and that's what I was kind of getting at earlier. I was hinting to it, right? Is people who, this is the time of year where we hear from people that say, do you know that if I would have sent my required minimum right to the charity, right to the church or something, it would have saved me this much in tax, right?
And how does that work?
Yeah, it's qualified charitable distribution. We've done podcasts about it. We've talked about it before. But if you send your required minimum directly to the charity, it never enters your income equation. You never have to pay tax on it. It's a great advantage. It's a way to save a lot of money on tax. For those that aren't doing RMDs, if you have appreciated stock in a taxable account, donating that appreciated stock is another way to avoid paying capital gains tax, right? We send the stock directly to the charity. They sell the stock. They're a tax-free organization. It counts as a full donation for you. You never have to pay that capital gain.
Yeah, I did that last year because our church is adding on and there's a capital campaign, and so that's how I handled that. So it's a win-win.
It is, and I think the important thing to remember, some people will say, well, what if I don't donate more than the standard deduction, right? It doesn't matter if you're donating stock, you're still avoiding paying the capital gains tax on that stock. Even if you take the standard deduction, it's a way to still give charitably, avoid paying the capital gains tax, and like you said, everybody wins. And
the QCD works the same way. It doesn't matter if you're using the standard deduction or not.
You're right, absolutely. So that's something that, at this time of year pops up into people's minds, and it's things you can put in place for the current year that will benefit you next year.
I want to sneak in one other thing here that is largely, not followed or people are not aware of, and that's for small businesses. The new I don't know if it was the new budget or the new tax law, from Washington. It says if you're a small business owner and you set up a 401k, there are tremendous tax credits available for that small business, which really, for the first year, covers all the costs that you'd have to have as a 401k for administration, thereby allowing yourself as the small business owner to contribute more, and giving your employees an easy place through payroll to save for retirement. So sometimes small business owners don't want to put something in place due to the costs, but some of these incentives are in place now to help ease that burden.
Yeah, that's a great idea, and if that's what it takes, to get the ball rolling for people, that's a great program.
So what about refunds? Maybe I already took advantage of all this stuff. I met with my CPA in the fall. I'm great. I got a refund coming. I guess you can apply it to future tax, right? Like leave it at the feds, let it roll forward.
Right.
But what if you're getting a check in the mail or a direct deposit? Then what?
Yeah, I think it's a good question, right? Because we kind of talked about what you can do if you find yourself in a position to owe, but what can you do if you get a refund? We talk to people about this a lot. If you have extra money or found money or a bonus or whatever it is, tax refund included, you can do three things with it, right? You can pay something off, you can save it, or you can blow it. There's only one bad choice, right? As long as you pay something off or you save it, we're going to be. It's a decision that will benefit you down the road. I think a lot of people get comfortable thinking their tax refund is like free money and they get like a free pass to blow it, right?
Yeah.
But don't underestimate what that is. Just like everything else, right? Over time, it adds up to be a lot. A $5,000 tax refund, if you just invest it and it doubles every 10 years, 5 becomes 10, 10 becomes 20, 20 becomes 40, right? By the time you retire, a $40,000, is a big difference from.
But spring break is right around the corner.
I know, right? It's very true. But, we think that, using it to save or paying something off, wiping out a credit card, especially nowadays, right? The credit card interest rates are so high. A home equity line, right? Those interest rates have crept up significantly.
Yeah, they're over 7% now.
Looking to take some of that money and be advantageous with it is a smart idea.
Sounds good. So, in a nutshell, meet with the CPA in the fall, meet with the CPA in the spring, right? Because we need a professional in our corner. Okay. Fund your IRA, HSA, Roth IRA, Solo K, SEP. Max out your 401. By the way, it's $22,500 this year, so make sure you set that. And if you're taking money out of IRAs, think about the charity option, QCD. And if you have appreciated stock, think about just gifting the stock, right? What else? I think that's it.
Yeah, I think those are all really good choices, and this is the time of year, I think, to put it at top of mind for people because they're thinking so much about taxes right now. Excellent. Well, if you would like a second opinion on what you're doing, and if you would like to talk with us about all the stuff that we just mentioned, we'd be happy to consult with you, have a second opinion. You can reach us at peakwm.com. You can even schedule online.